All right. Hi, everybody. This is going to be a real down and dirty market update this month. Just a lot going on. Have one in escrow, showing leases, working out some potential development consulting. So really, really busy. Wanted to just go over quickly what's going on in the housing market. I know we've seen a lot of changes and a lot of adjustments over a very short period of time. That is translating into the stock market as we speak. This will generate into probably some equity destruction in the stock market. I mean, we've already seen billions of dollars go out of the stock market as far as, 401ks and retirements and stuff like that. That said, a lot of people kind of saw it coming and they've been sitting in cash on the sidelines. If you're not in cash, I'm not a stockbroker or an investment analyst for, Charles Schwab or anything, but do you want to take the chance? That's all I can say. Long-term holdings, different. But anything speculative, why? So the economy's been in flux, and I went through this in one of my recent Real Cap Dailies, this new kind of daily thing that I put up, just like a quick 2-minute video, playing chicken with the Fed. I love the name and the title, but it's so true. And so I'm going to leave a link right up above. You can check that out. It's a 2-minute video. Or you can find it on my YouTube page. It's on my blog, on my website. It's there everywhere. So I'm not going to go really deep into where interest rates are going, and that's done in that video. So just go watch that. But as far as interest rates with the mortgages, just this morning they pushed up to over 7% again at 7.08% for conforming. Jumbo rates, I still see a lot of really good jumbo rates out there, and generally because it's not a government-backed product, it's more of a floating rate product, and to qualify for jumbo, you have to be just more qualified in general. You're going to be putting more down. You're not going to be doing anything that's overly risky. We're talking about people who make, great incomes. So, still can get great rates on that. I mean, we're talking about in the fives. So that's still available. If you want something like that, or you want to talk about, potentially selling your home, I'm happy to go over it with you and purchasing a new one. Now, so let's move on a little bit. I'm going to get through the slides as quickly as possible. So if you see me looking away, it's just because I don't have time to type this up like I normally do. So inflation's been very persistent at 8.2%. It's not going anywhere. The thing that I really want you to notice on this chart is the red bar, and I'm pointing it out on this slide, is sticky inflation. Sticky inflation is the core inflation, but it's that stuff that does not go away. Wages. When inflation happens and wage inflation happens, that's when it just persists forever, because wages they don't go down. They'll go up and they'll plateau. Yes, wages have been falling behind on inflation. That's very clear on this chart, but they are still rising, and we are seeing sticky prices continuing to climb upward. Some of the things that we've been really watching is the gasoline and natural gas. And gasoline has come down considerably from the 50% month-over-month inflation that it was experiencing. And this was really hurting consumers. But we're also seeing that nat gas is now starting to climb. And it has been climbing since 2020. It was starting to come down, and then the Ukraine war happened and it spiked up again. And Europe has been stockpiling nat gas from us for a significant amount of time, since basically through the summer, since they knew they were going to have a problem. So a lot of the stockpiles in Norway and stuff like that were stocked up from us. We were exporting, which is why prices continue to stay elevated in nat gas. But now we're going into the winter, and heating oil and nat gas prices are a problem. So, and it's going to continue to go higher because we're not producing enough. We need to be producing a lot more of oil and natural gas just to cover our operations and daily needs. In September, we also saw food climb. This is going to be a continuing theme. Food at home especially is up 13%. That's huge. That's 5% over the current rate of inflation. That is hitting consumers and homeowners. So, people are adjusting how they're spending their money and where things are going. That will continue. especially as now the cost of fertilizer has skyrocketed because we're not producing enough oil and natural gas in order to produce the fertilizer. So the input costs go up, the fertilizer cost goes up, the food prices go up, the transportation costs go up, everything goes up. It's a feedback loop, all going back to energy. So I want to just quickly read this quote to you. I've read this before and they quoted this figure, but it's from Odetta Kushi at First American. U.S. households own $41 trillion in owner-occupied real estate, just over $12 trillion in debt, and the remaining $29 trillion in equity. The national LTV, or loan to value, in Q2 2022 was 29.5%, the lowest since 1983. Homeowners had an average of $320,000 in inflation-adjusted equity in their homes in Q2 2022, an all-time high. So what is the point of this? Well, the point of this is that homeowners are in a great position. The number of loans out there in the marketplace is not high. In fact, 35% of homes in this country are owned free and clear, no mortgages. So we're not likely going to see the same kind of scenario or crash that we saw in 2008, 2009, 2010. Just the mortgage underwriting standards are solid. People are really being looked at very carefully, all the buyers who are buying. And a lot of the buyers are putting down a ton of equity. I've known that many people who have closed out, high valuations in their 401k before they start falling and, moved into the homes. They're not going anywhere. They don't have to sell. And this is common across the country. So really, the people who are going to have to sell will be, the usual go-tos, like the life-changing event people. They're going to have to sell. And they will have to adjust to the market. But we're not going to see a massive influx of foreclosures like everyone. I know there's some people on the sidelines who are hoping for. We're just not going to see it. Moving on, let's talk about the national housing market. So I just want to go through some key stats and facts here really, really quickly. Inventory across the country increased by 33.5% in October, year over year. The pending inventory, that means pending sales nationally, fell by 30% year over year. So that's a pretty substantial slowdown in the number of pending transactions. The number of newly listed homes declined by 15.9%. That means there's 16% fewer homes listed on the market right now than there were just a year ago. And the median list price grew again by 13.3%. In other words, sellers are still trying to push the envelope on the list price that they're asking. However, that is starting to curtail. And we'll take a closer look at Los Angeles here in a second, and you'll see what I'm talking about. Time on market nationally went up to 51 days. That's 6 more days than it was. But it is 20 days less than the pre-pandemic levels. So it's still in line. Price reductions continued. And those increased to 20.9% nationally. I would like to mention that October is typically the peak for price reductions. It's a seasonality thing. You have listings that are left over from this summer that just did not sell, and people put them on the market as a price reduction before winter comes in and freezes things over, and then they can't sell anymore. So October is typically the peak for price reductions. We probably won't see that again next month or in January. So I'm going to go through the Los Angeles marketplace very, very quickly. This is going to be down and dirty. The number of active listings, as you can see on this, has declined pretty dramatically. It's still at extreme lows, 9,000 odd active listings. The number of pending sales, though, has fallen off the cliff. Like you can see, now we're starting to see where the number of pending sales and the number of people who are out there actually purchasing it's falling off. To be expected. Number of closed sales is slowing in single families as well. The average days on market is 33. It's climbing. It's still well below the national average, but this is normal for LA to be this low. See, month supply is at 2.8. It's climbing off of extreme lows. You can see that in the lower right-hand corner, but we're still nowhere near where we need to be in a buyer's market. You have to get above 6 months supply to be in a buyer's market. The other thing I want to show you was the average percentage of list price. Los Angeles, 97.5% on single families. Condos are different. The median sales price in LA is $890,000. It has pulled back from its $990,000 peak, $995 peak. And the average price per square foot has pulled back as well at $649. Sometimes can be a little wonky because you might have a $50 million home sell and it will adjust the price per square foot, believe it or not, depending on the number of sales in a month. So it stays a little wonky, but that's pretty consistent. For condos, we're currently just over 2,000 listings. As you can see, it's still really, really low inventory. But on this next slide, you're going to get a really good sense of pending sales. Now, what I want to comment on this is that pending sales and condo sales tend to be more cyclical, more like the rest of the country as far as sales in general. Part of the reason, I don't know why, I guess people just don't want to move during Christmas time or the holidays, but the number of sales just drops off. But we are at decade lows for pending sales in condos at about 422 are currently in escrow right now. So pretty low, but it's still cyclical. So just keep that in mind. This is the cyclical time of year. And you can see that in the number of closed sales too. It keeps on going up and down, up and down, up and down. It just does this every single year. For percentage of list price, as I mentioned earlier, 98.2%. So condos tend to be pricing a little bit better right now, but expect that trend to adjust. As we get into next year, we'll probably see fewer price reductions as well. Average price per square foot, $615, and the median sales price is $605. So I hope that helps. It's a quick, dirty update on the market. I know it's been a minute. Tried to do this as quickly as possible. I just did not have time to type it up. I could have crammed this in 5 minutes, and if you made it this far, bravo, congratulations. If you need help buying or selling real estate, please reach out. And it's a great time to invest in real estate as things adjust. Probably going to see some adjustments in the investment market more than we're going to see in the housing market. So things to keep in mind. Reach out and I'm happy to talk to you about it and let you know my thoughts and ideas of what's going on. Look forward to chatting with you and take care.